Today, I'm going to explain why my next 100 share investment is going straight into SCHD, the Schwab US Dividend Equity ETF. Now you might be asking, why SCHD and not just something broad like VOO, which tracks the S&P 500? After all, the S&P 500 has been the gold standard for decades. But when we dig into valuations, dividend growth, and how diversification actually plays out inside these funds, SCHD starts to look like the smarter, more forward-looking investment for my portfolio. Let's start with valuations, because price always matters. Right now, the S&P 500, tracked by VOO, is trading at a forward earnings multiple above 21. Historically, US equities have averaged closer to 15 or 16 times forward earnings. So when you pay 21 times earnings, you're assuming near perfect execution from the companies inside the index. That's a tall order, especially in today's environment of higher interest rates, slowing growth in certain sectors, and global competition. Now contrast that with SCHD. Because SCHD screens for quality dividend payers with strong fundamentals, you end up with a portfolio that trades closer to 15 or 16 times forward earnings. That's right at historical averages. Not frothy, not overly cheap, but fair. Think about it like this. If you were buying a rental property, would you rather pay 21 times the rent or 15 times the rent? The math is simple. The cheaper price you pay for $1 of earnings, the more room you have for your investment to compound over time. This valuation gap is one of the biggest reasons my next investment is SCHD. I want to own companies where expectations are reasonable, not where everything has to go right just to justify the current price. Next, let's talk about dividends. VOO's yield right now is about 1.3%. That's fine for broad exposure, but it doesn't really move the needle for income investors. On a $100,000 portfolio, that's only $1,300 a year, barely enough to cover monthly groceries. SCHD, on the other hand, is yielding around 3.5%. On that same $100,000, you're looking at $3,500 a year in cash flow. That's nearly triple what you get from the S&P 500. But here's the kicker. It's not just about today's yield, it's about the dividend growth rate. Over the last 10 years, SCHD's dividend has grown at an average rate of 10% annually. That means your income doesn't just stay flat, it grows significantly year after year. Compared to VOO's 10-year dividend growth rate of 6.5%, SCHD is the better source of income. Let me give you a quick example. If you invested $10,000 into SCHD 10 years ago, you would have started with a dividend yield in the 3% range. But thanks to dividend growth, your yield on cost today would be closer to 8 to 9%. That's the power of compounding income. VOO simply doesn't offer that kind of growth in distributions. Yes, you get capital appreciation, but for an investor like me who wants to eventually live off dividends, SCHD sets me up for much stronger cash flow in the future. Now let's dig into diversification, because this one is overlooked. On paper, VOO looks extremely diversified with 500 holdings, but here's the reality. The top 5 companies, Apple, Microsoft, Nvidia, Amazon, and Meta, make up around 28% of the index. The bottom 250 companies, literally half of the S&P 500, barely move the needle. Their combined weight is only a few percentage points. That means VOO's returns are heavily dependent on a small group of mega-cap tech names. That's not bad when tech is running hot, but it creates concentration risk. SCHD is different. Its 100 holdings are weighted more fairly, and the bottom 50% actually matter. They contribute a meaningful portion of the fund's performance. That's real diversification when the smaller holdings actually have influence. On top of that, SCHD tilts more towards sectors like industrials, financials, and consumer staples. That means you're not just betting the farm on big tech. You're spread across different areas of the economy that historically provide stability and cash flow. So while VOO might look more diversified on paper, SCHD's construction gives me a more balanced risk-return profile. When I put all of this together, fair valuations, stronger dividend growth, and real diversification, it's obvious why my next 100 shares are going straight into SCHD. I'm not saying the S&P 500 doesn't have its place. It's a great benchmark and a great core holding for many investors. But today, in this market environment, I see SCHD as the better long-term bet. With SCHD, I'm buying a collection of high-quality, dividend-growing companies at reasonable prices. I'm locking in a yield that actually matters today, and I'm giving myself the chance to see that income snowball grow faster than inflation for years to come. That's why I'm optimistic about SCHD. It's not just an ETF, it's a tool for building long-term financial independence. And that's why my next investment is 100 shares of SCHD. Thanks for watching. If you found this breakdown helpful, make sure to hit that like button, subscribe to follow along, and join me as I continue building my SCHD long-only portfolio, one share at a time.